In 2019, the IRS mailed 10,000 letters to American crypto investors or holders. The commissioner of the IRS told the country to take them very seriously. This year, that same agency mailed out 87,000 letters. The rule each letter cites did not exist when you bought your Bitcoin, and the deadline on the worst version of this is in 30 days. Here's exactly what you need to do this week.
Picture opening a letter from the IRS that says you owe tax on $150,000 in crypto profit when you know for a fact you barely broke even. You are not a tax cheat. You bought some Bitcoin years ago, moved it between wallets the way every security guide told you to, and eventually sold it for roughly what you paid. But the letter is real, the number is real, and the 30-day clock printed at the top of it is real. And here is the part that should chill you. No human at the IRS decided you owed that money. A computer did. Stay with that letter, because 3 things are about to come clear. How a brand new automated system can bill an honest holder for money they never actually made. Why a wave of forced selling is now wired to the tax calendar instead of the news. And how the people who understand both end up buying while everyone else is panicking. This is general information, not tax advice, and I am not your accountant. So take what follows as a map, not a substitute for a professional who knows your records. Back in 2019, the IRS mailed roughly 10,000 of these warning letters to crypto holders, and the commissioner at the time, Chuck Rettig, told the country to take them very seriously. But that wave was built off a single court order, a so-called John Doe summons that pried the names of some 14,000 customers out of one exchange, Coinbase, and even then, a human being still had to suspect you first. This year, it is not a human. On the 1st of January, the rule that finishes the job switched fully on, and the letters are already surging. One crypto tax software firm logged something like an 8-fold jump in people mentioning IRS letters in just 2 months, more than a 700% spike. The rule each of those letters leans on did not even exist when most people bought their coins. So what changed? And why did a warning turn into an automatic bill? A new tax form called the 1099-D now does for your crypto what your bank already does for your paycheck. Your exchange reports your sales straight to the IRS, and a computer quietly compares that number to what you put on your tax return. If the two do not match, the letter generates itself with no agent in the loop, which is exactly how thousands of ordinary holders who thought they were fine are suddenly getting mail. And here is the trap built into it. In this first year, the form reports what you sold, the gross amount, but it often does not report what you originally paid. When that cost field comes back blank, the computer does not call to ask. It assumes you paid nothing and treats the entire sale as pure profit. You do not have to take my word for how ugly that gets, because the attorneys who fight these letters every week say it plainly. The lawyers at Kugelman Law describe the automated system seeing the full amount reported by Coinbase or Kraken or Robinhood, having no idea what you actually paid, assuming it was zero, and wildly overstating what you owe. The team at Gordon Law is blunter still. They say the number the IRS proposes is usually way off base, and they have had clients whose real records turned a terrifying bill into an actual refund. That is not a hypothetical. One client got hit with a bill for more than $30,000 after the system misread his crypto, and once the real records were shown, it flipped into the IRS owing him money instead. And it is not only sales that trip the wire. Staking rewards, airdrops, and coins earned from mining all count as income the moment you receive them, and they create their own basis. So when an exchange reports the later sale without any of that backstory, the machine can tax the same coins twice over, once as phantom income and again as phantom gain.
Hey everyone, real quick, just to want to jump in, I just put 2 courses together to change how you invest in crypto. I put together the Crypto Research Pro and the Crypto Security 101 course. Links down below for one price. If you want to learn a lot more about investing in crypto than just what everybody talks about on the internet, links down below. Now let's get back to the video.
The comforting assumption is that if you did nothing wrong, the machine leaves you alone. The opposite is true. The machine cannot tell the difference between a tax cheat and a long-term holder who moved coins between his own wallets, because when the cost basis is missing, the two look identical. Tax attorneys who watch this shift describe it as the IRS quietly moving to an opt-out model, where you are presumed non-compliant until the data clears you, instead of the other way around. And the mismatch is almost engineered to happen, because each exchange only reports what occurred on its own platform. Buy on one, move the coins to a wallet, sell on another, and the forms will never line up, even when you paid exactly the right tax. Doing everything by the book is not the protection here. The paperwork that proves it is. The other comforting story is that the new administration is about to make crypto tax-free, and this whole thing disappears. It has not, and it is not about to. One narrow piece aimed at decentralized finance got rolled back last year on a bipartisan vote, but the core reporting machine is live, funded, and built into law, and nothing in front of Congress unwinds it. So picture this happening to hundreds of thousands of people at once, many of them without the cash sitting around to pay a surprise bill. Because the tax deadlines fall on the very same dates every single year, the selling that follows does not cluster around the news. It clusters on the calendar. Holders who have to raise cash sell other coins to cover the bill, and that creates a wave of forced selling near April and again in the fall. That has almost nothing to do with whether Bitcoin or Ethereum is actually healthy. It is predictable, it repeats, and the prepared holder steps to the side of it instead of getting run over. Reconstructing your cost basis before the letter ever arrives is exactly what Crypto Research Pro is built to walk you through, with Crypto Security 101 on the storage and self-custody side. So here is how you end up the documented one and the calm one instead of the cornered one. Again, general information, not tax advice. First, understand the cost of waiting. If you cannot prove what you paid, the machine's number stands. And the penalty for getting basis wrong on a real understatement runs 20% and can climb from there. So pull your complete history now, every exchange export and every wallet transfer, while the platforms still have your data, because dormant accounts have a way of locking it away. And lock in your cost basis method before you file, because the IRS has now thrown out the old approach of pooling everything together and wants it tracked wallet by wallet. And the default method can quietly cost you more than you actually owe. Second, if a notice does land, respond inside its window with documentation rather than ignoring it. Silence is not neutral. When the clock runs out, the computer's guess quietly becomes your final legally owed bill. And then the collection tools come out. Third, position for the wave instead of becoming it. Harvest your losing positions early and keep some cash ready, so that when the deadline sellers are dumping to make a payment, you are the one calmly reading the opportunity instead of feeding it. So go back to that letter on the kitchen table. The $150,000 gain you never made. The 30-day clock ticking, and the quiet fact that a machine, not a person, picked your name and decided you owed it. We have watched the government end an off-the-books era exactly once before. In the 1980s, Washington forced the banks to report the interest they paid you, and the day that reporting switched on, quietly underreporting your savings was simply over, because the paperwork now showed up at the IRS whether you mentioned it or not. That is precisely what just happened to crypto 4 decades later. Except this time, a computer flags everyone at once. The era when crypto lived in the dark did not end with a raid on a warehouse. It ended with a form. And the only thing that decides whether that form is a refund or a ruin is whether you kept the receipts. The automated notices, the missing basis trap, and the deadline-driven selling all run on a clock you can read in advance. Those 3 are what we watch here. So you have your proof in hand before the machine ever picks your name, not after. Economic Ninja is out.